Bueno, buen día. Vamos a cambiar un poco de tema. Vamos a hablar de evaluación de empresas y de mercado de compras y adquisiciones. Vamos a primero a escuchar a Bruce Cropchop, que es Senior Managing Director de Alta en M&A para Estados Unidos y también globalmente supervisa el resto de los negocios de esta área en el mundo. Bruce tiene casi 30 años de experiencia en este mercado, entonces por eso lo invitamos a que comparta la experiencia y hablar un poco de cómo ve el mercado él a nivel mercado global en Estados Unidos, cómo cuenta un poco de las transacciones de los últimos años en las que participó y vio, y cuáles son las expectativas de los dos lados, de los compradores y los vendedores, y cuál es la función también de un asesor de M&A. So, Bruce, I pass you the baton.
Thank you, Guillermo. I head the Alta Group's Merger and Acquisition Advisory practice in the United States, and consequently most of my involvement has been in the U.S. market. Have participated with the Latin American region of the Alta Group, though, in some activities. I'll tell you, based upon my experience principally in the U.S., how the M&A market has been, but then certainly you're more interested in the Latin American market, and Guillermo and Ulysses will fill you in on that. In the first slide that we had, we talk about the merger and acquisition business having several different segments. Sell side representing sellers of equipment leasing and financing businesses. That is the end of the market that I started when I first became a merger and acquisition advisor in 1986. My background, I had been in vendor leasing for 14 years. My business partner and I sold our vendor leasing business in 1981, and I stayed on and ran that business for 5 years, and then decided there was a need in the marketplace for a merger and acquisition advisory firm that understood the leasing business, and that's when I established my firm, which eventually merged into the Alta Group. Starting out principally working with independent leasing companies on sell-side assignments. We've, in recent years, represented buy-side assignments in a number of transactions. So we're working with buyers and sellers, and that makes a good mix of our business, because we have to be aware of who the buyers are if we're going to serve our seller clients, and similarly we have to be aware of who potential sellers are when we're representing the buyer clients. In the middle of the chart here, you see the word lift outs, and I don't know if that phrase is used in Latin America, but in the US there have been a number of alternative transactions to an outright sale of a leasing business, and that's when a group of leasing employees who have worked together for one company leave that company and go together to start a similar business for another company. Now, many of the lift outs are done with people also who have been displaced through corporate changes, and I would imagine that there are going to be a few lift outs of GE Capital employees who will be joining other firms now that their businesses are being acquired. This alternative, one of the recent examples of was a transaction that the Alta Group helped arrange. We were contacted by 4 senior executives of AIG Equipment Finance, and because their market had been changed by their parent company, which is in the insurance business, they were no longer able to compete for many of the attractive business opportunities that they had previously been involved in. So they asked us to help them find a new home, and we were successful in locating a $12 billion bank in the Chicago area that had very little involvement in equipment finance. This made a perfect entry for them, for that bank, to get into equipment finance. And that 4-member team from AIG came on board with the bank in April, and they've already done over $100 million of business with the bank and have increased their employment level to about 15 people.
Excuse me, Bruce. One thing later Luis will talk about, but it's kind of lifts out your story also, right, Luis?
Yes. The lift outs are sometimes difficult to accomplish. We had one group of employees that we couldn't find the exact right opportunity for them, so they stayed where they were. And 3 years later, the Alta Group was retained by a large international bank to add an equipment leasing capability to their U.S. bank, and that created the perfect opportunity for this team of individuals. I want to talk a little about the current M&A market focus. The influences on the M&A market, certainly the biggest influences on the M&A market for equipment leasing companies has little to do on the equipment leasing industry and more to do with what is happening in the overall economic environment. In order for acquisitions of leasing companies or any kind of business to be in favor, there has to be a high degree of business confidence. The acquirers have to feel good about themselves, their future prospects, and the opportunities for growth. And the overall economic conditions have to be favorable. Certainly it's not a surprise that merger and acquisition activity in equipment leasing, as well as most other areas, declined precipitously in 2009 and 2010 after the meltdown in the worldwide financial markets in 2008. The liquidity in the financial markets has an influence on the M&A market. When banks are flush with cash and credit is easy to obtain, it makes acquisitions much more likely. Interest rate levels are important. When interest rate levels are low, buyers generally have a lower hurdle rate for return on investment, and that makes acquisitions more attractive to them and to the sellers. The price earnings multiples of publicly owned stocks in the leasing industry or in general will have an impact on the valuation of leasing companies, and when there are good valuations in the overall public stock markets, that makes it easier for the buyers to justify a higher price earnings multiple when they are acquiring a company. You'll notice that those reasons influencing the M&A market have nothing to do in particular about a leasing company, but certainly it does. The attractiveness of a leasing company in the acquisition market does depend upon how well they're doing, of course, and what their future prospects are. Now, the sellers in the leasing industry in the U.S. have been principally independent leasing companies. There have been very few situations where there have been sales of leasing companies owned corporately, although that certainly the GE Capital disposal of most of their leasing businesses, that has been a departure from the norm. But independent leasing companies, many of whom were started by the management team, at some point in time, they're going to want to get liquidity for their personal financial status. They're going to want to have an exit strategy so that they can retire someday. So the life cycle of an independent leasing company usually ends up in them selling the business at some point in time. As I said, GE Capital got out of the business for reasons unrelated to the success of their business, but more related to overall corporate objectives. And sometimes major corporations have shifts in their strategic focus, and that results in them exiting an equipment finance business. Banks usually are in the leasing business forever once they get in, although troubled banks have been sellers of equipment leasing businesses from time to time, and certainly back in the 1990s when there were many troubled financial institutions in the U.S., many of the sellers were troubled financial institutions. Buyers of equipment leasing businesses in the U.S. have, in the current market, it's been dominated by banks. In the U.S., there are over 7,000 banks, and the top 100 banks almost all have established equipment leasing businesses. But for banks with under, say, $10 billion of assets, many of them have not been in the equipment leasing business. Now that they're flush with cash, they don't have a huge commercial loan demand, many of them are looking for new ways of deploying their investment dollars. And equipment leasing has proven to be an attractive source for those banks. And just recently, in the annual survey of the top leasing companies done by the Monitor, just like Alta does the LAR 100, the Monitor, a leasing publication in the U.S., publishes their annual list of the top 100 leasing companies. And for the first time, just recently, over half the leasing volume among the top 100 companies was generated by banks, and that number has been growing in recent years. Other acquirers of equipment leasing businesses include other leasing companies, companies that are looking to diversify the businesses that they are in. And increasingly, we've seen private equity firms invest in the equipment leasing business, and I know you've seen that also in the Latin America market. Private equity firms have been able to raise many billions of dollars of investable funds, and whereas at one time most of the private equity money was going into high-tech businesses and in the IT area or in the healthcare area, now there are many private equity firms that will invest in financial service companies. I know in our target list of potential buyers, we have over 30 private equity firms that have expressed interest in investing in the equipment leasing sector. Some of them have already done so. And one thing about private equity firms, success breeds success. When a private equity firm sees another private equity firm having very good fortune in investing in an equipment leasing business, that makes them much more inclined to consider the equipment leasing sector. And one of the recent success stories in the private equity field has been an investment that FlexPoint Ford, a private equity firm, made in Financial Pacific Leasing. And Financial Pacific Leasing is a subprime leasing company. They buy their leases from lease brokers and small leasing companies throughout the U.S. Their average lease size is about $20,000, and the company had very high loss rates in the 2008 to 2010 area, but with the new management team, they turned that company around. The private equity firm FlexPoint Ford sold the business less than 2 years after they bought it, and they sold the business for about 2.5 times what they paid for it. And this was a sizable company with a lease portfolio approaching $400 million. So it was over $100 million gain on the sale of this company, and that has sparked interest on the part of other private equity firms to look for independent leasing companies that might have an opportunity for rapid growth, because, as you may know, private equity firms almost always invest only with a short-term horizon. 3 to 7 years typically is their plan, and they don't invest in a company unless they've already considered what their exit strategy might be. Now, I'd like to talk a little bit about valuation levels and how the valuation levels can impact the M&A activity. And certainly it is based upon demand and supply, as the entire economy is. When the fortunes in the overall economy are bad, there's not a whole lot of demand, and the supply dries up too. Now, though, the demand is great. The buyers that we mentioned, banks, private equity firms, and other leasing companies, have a big appetite to make leasing company acquisitions. The supply is relatively low. There are not a huge number of sizable independent leasing companies remaining in the U.S. market. There's been tremendous consolidation. Our firm alone has arranged the sale of over 200 equipment leasing businesses since I got in that market 29 years ago. And so many of the big and better leasing companies have been acquired. So what happens when there's a great demand and a relatively small supply? As you know, prices go up, and that's created a very favorable environment in today's market for the valuation of leasing companies. Now, from the seller's standpoint, their consideration today needs to be, is it the right time in our company's history to sell? Certainly it's the right time in the overall marketplace to sell, but some companies just aren't ready to sell. But the important thing to keep in mind for any independent leasing company that's thinking of selling, always be preparing your company for the sale. It might be 2 years, it might be 10 years when it's the right time for you to sell, but continue to do what you can do to make your company more profitable when that right time comes. From a buyer's standpoint, buyers have to be very careful in evaluating acquisition candidates. There have been a lot of very good experiences. There have been some bad experiences that buyers have had, and there's no substitute for detailed due diligence if you're buying an equipment leasing business. The Alta Group does offer due diligence assistance to buyers who are considering the sale of a company, and the focus of our work when we are helping a buyer decide whether the investment opportunity is good, the biggest focus is on the two areas where there's the biggest opportunity for there to be problems down the road. One is in the area of collectability of the receivables. Now most leasing companies have very good delinquency statistics, but you only have to go back 3 or 4 years, probably in your own leasing company, to know that delinquency levels can increase significantly during a bad economic cycle. So when a buyer is considering the acquisition of a leasing company today, if the delinquency numbers look very favorable, if there are very few losses, it's important to consider that these are the best of times in terms of the economy for most leasing companies. Therefore, you need to take a look at the adequacy of the reserve for losses in light of what happens in a downturn in the economy, what happens when credit gets tighter, interest rates rise, and many of the small businesses may have trouble supporting their investment in equipment. The other area where buyers need to be careful is in residual valuations. Many leasing companies have shown substantial profits on the sale of equipment at the lease maturity, and that's good. But a buyer needs to be aware that sometimes residual estimates in the accounting records may be overly optimistic. It's important to take a look at what the experience factor has been and determine if that experience is likely to continue in the future. So, as I've said, the current M&A market for the equipment leasing business is good. It hasn't been this good in the U.S. market since around the 2005-2006 area. The attractive market today, though, could be short-lived. It's been a good market for the last 3 or 4 years, but that can change very quickly. So it's something that if you're a buyer or a seller, you need to keep your eye on what the trends are. In terms of valuation methods, there are a number of ways of valuing a company when it's for sale. The seller may look at it one way. Different buyers may look at it other ways. Valuation is not a precise science. In fact, you might say it's an inexact art. You've heard the expression, beauty is in the eyes of the beholder, and that is certainly true in the valuation of a leasing company for acquisition. You will find in any sale of a leasing company that there are a few potential buyers that place an extremely high valuation on the company and probably a few that place an extremely low valuation on the company. That's why it's important to have a competitive process in the sale of any leasing business, because you don't want to sell to the first offer because that might be much lower than what somebody else is willing to pay. They say in terms of a definition of fair market value, it's what a willing buyer and a willing seller are willing to pay in a negotiation, with each party being aware of all the pertinent facts. Well, that's a textbook definition, but it gets down to a lot of negotiation in the final analysis, and as a representative of a seller, we're looking for the buyer who's going to place the highest value on that business. We've found that the most important determinant of value or criteria used by a buyer in valuing a leasing company is on a price-earnings multiple basis. And that multiple can be a multiple of historical earnings, a multiple of the latest year's earnings, a multiple of the last 12 months' earnings, or sometimes on a multiple of the projected next year's earnings. And those multiples can vary significantly depending on who the buyer is. I know a lot of you would like me to tell you what the current multiple is for buying a leasing company, a multiple of earnings. It's impossible to say because different leasing companies are more attractive than others, and the higher multiples are reserved for those companies that are somewhat unique and have great growth prospects. Now, representing a seller, we're certainly wanting to sell that company based upon a projection of what this company can earn in the future. Buyers are more influenced by historical earnings. In looking at what multiples to use, historically, we've looked at multiples of publicly owned companies in the same sector. That doesn't work very well today because in the U.S. there are very few publicly owned leasing companies. At one time there were more than 10 publicly owned general equipment leasing companies. Now, with the exception of aircraft leasing companies or vehicle leasing companies, there are probably only 2 pure plays in leasing in the U.S., and one of them, CIT, now looks much more like a bank than they do a leasing company. So really the only pure play is in leasing companies that are publicly owned in the U.S. is Marlin Leasing. And Marlin is a small ticket lessor with an average lease size of about $15,000. So that company, their price earnings multiple may or may not be an important consideration in valuing an altogether different type of leasing company. There are a couple of publicly owned leasing companies in Canada that we also consider in looking at multiples. Chesswood is also in the very small ticket market, and most of their leasing business is done through a company that they acquired from an Alta Group client in the U.S. And the Canadian and U.S. stock markets have generally followed fairly similar valuation patterns, so we do look at Chesswood as a comparable for leasing companies. Another leasing company in Canada that's made big waves in the last couple of years is Element. They've been a major buyer of companies, in particular GE's transportation finance business. And Element now is mostly a transportation finance company. So we have very few public multiples to refer to in comparing multiples of leasing companies. We do look at multiples of banks. They are certainly financial service companies. And also keep in mind that a privately owned company generally is going to sell at a lower multiple than a publicly owned company. And public company acquirers need to acquire a business for a lower multiple than their multiple if they're going to show accretion in their earnings per share to their shareholders. Some people value leasing companies at net asset value. Certainly in a liquidation mode, a leasing company is worth what the assets are. But acquirers are not looking to liquidate a company, they're looking for a going concern. So sometimes they will look at what the value of the assets are and then add a premium. What is it worth to buy a going platform of a leasing company instead of starting their own? So in some cases, leasing companies are valued at a particular figure above the book value of the company. That is particularly true when we sell an equipment lease brokerage business. Equipment lease brokers generally have some fairly decent earnings, but it's all gain on sale accounting from selling their leases. They don't keep much in the way of net worth because they have no need for it. They are not a borrower. But the value of their franchise, the source of their leasing business, their vendor relationships, their employees in place, have a value to an acquirer. So it's not unusual for us to sell a small lease brokerage operation for a premium of $3 to $5 million over their book value, and the book value may be practically zero. But there is a going concern value that that business has. Now, if you've gone to a business school and studied the textbooks on how to value a business in an acquisition, you would learn that the theoretical way of valuing a business is the discounted cash flow method. Determine what your required return on investment is, run projections of the acquired business for a 5 to 10 year period, discount the future cash flows generated by the business, and then discount the projected future value of that business at the end of your discount period. Well, that's all fair and well from a textbook standpoint, but that method requires an awful lot of assumptions. It's very theoretical and not utilized all that much in business, other than as a test to see if the other valuation methods, particularly the price earnings multiples, do have some theoretical justification. As an M&A advisor, the Alta Group is responsible for getting deals done, and usually it's not unusual for there to be a gap in the valuation by a buyer and what the seller thinks a business is worth. So how can we, as advisors to a seller or to a buyer, bring them closer together? Well, number one, if we're representing a seller or a buyer, we initially want to make sure that they have realistic valuation expectations. Nothing is more frustrating to be representing a seller that thinks they're worth $10 million and they're really worth $5 million. If we don't let them know a realistic valuation at the beginning of the process, they're going to be disappointed. We're going to be disappointed because we're compensated largely on success fees, and there's not going to be a successful sale of this business if the seller is totally unrealistic about the value of their business. We also want to make sure that we identify the most important deal points for the buyers and for the sellers. We represent currently a very attractive seller, but that seller has one paramount consideration in addition to price. They're very loyal, the seller's very loyal to the employees. They will not sell to anybody that's going to centralize the back office functions. That doesn't mean that the business isn't saleable, but there are certain categories of buyers that we can't expect to complete a sale with because this company really needs to stay intact, or the owner, who's the president of the company, will not sell the business. That's certainly a commendable attitude on his part. He'll probably have to sell the business at a discount to what it might be worth to some buyers, but he's doing the right thing for his employees. One of the most important ways in which we've been able to narrow the gap between the buyer and seller valuations is through an earn-out arrangement where the seller takes a little less than what they would like to take in the initial sale, but they have an opportunity for an upside. They can achieve a greater price for the company if it achieves certain target levels. And we've had sales of businesses where the ultimate selling price was 3 times what the upfront cash payment was. Certainly that was a win-win for the buyer, it was a win-win for the seller. You've heard the expression, put your money where your mouth is, that the seller is willing to take part of what he is expecting on future performance, then that creates a good feeling on the part of the buyer. They know the seller is going to be motivated to achieve those results. Now this works only when the seller is also an important part of the management team. When my business partner and I sold our leasing company, we sold 80% of it with each of us retaining 10% and the buyer having the requirement to buy the remaining 20% of the business on a formula basis based upon results during the intervening period. And fortunately for us, the business did well. We were able to utilize the additional capital that the acquirer provided to us, and we ended up selling the final 20% for more than we did the initial 80% of the business. So I'm a strong believer in earnouts, but they're very difficult to craft. It's you need to have good legal input and good business input to structure something that is fair to both the buyer and seller, and that is definitive enough that it doesn't result in arguments down the line. This chart sort of demonstrates the cycle of business ownership in a leasing company. Many leasing companies are started by people who've been in the leasing business. They like the business, they go out on their own and start their own company. Initially, maybe because of lack of capital, they become a lease broker. They retain equity in the company, they hire more people, maybe they get a capital infusion from family and friends or outside investors. They start to retain part of their originations in their own portfolio. They grow that portfolio. The business becomes more and more successful, but the owner has most of his personal net worth wrapped up in the company. He knows that he's going to want to retire someday. He knows that when he sells the business, the buyer is going to want him to remain with the business, most likely for 3 to 5 years. The business is worth more on a sale basis with the owner staying than if the owner leaves immediately. So he starts to look for alternatives. So this is the typical cycle of an independent leasing company from start to sale. So if you're early in the phase, it's never too soon to plan ahead and how to make your business more profitable, the point that you're eventually going to sell it.
Doesn't work? Yeah.
Okay.
I think we'll skip to 2014-15, right?
Okay. Now, we have some recent transactions in the U.S. market, just to give you an idea of what types of companies are being sold. Marquette Equipment Finance was a middle-ticket lessor and was acquired by a bank. The Alta Group performed due diligence on that company, not for the successful buyer, but we helped our potential buyer to make a bid that was reflective of what they thought the value was. The sale of First American Equipment Finance was a very interesting one. First American is one of the most successful independent leasing companies in the U.S. and one of the largest. It had often been approached by potential acquirers, but the owners, the two senior executives of the company, never wanted to sell. They were happy doing what they did. They were making very significant profits in the business. The Alta Group was retained by City National Bank, one of the 25 largest banks in the U.S., based in Los Angeles, which was acquired just a couple of weeks ago by Royal Bank of Canada. But City National Bank had a very small leasing business. They were a big bank and wanted to have a big leasing company. So we helped them develop a strategy looking at various alternatives in the equipment leasing business. And we discussed with them about 20 companies that we thought might be good candidates for them. We narrowed it down to a very few companies, and then finally we told them and they agreed with us that First American might be their first choice. They knew that First American wasn't willing to sell, but the president of this bank, the CEO of this major bank, made a trip to Rochester, New York, to try to convince the president and co-owner of First American Equipment Finance that the leasing company should sell to them. And it worked. It was a marriage made in heaven, so to speak. The City National Bank made a very attractive offer. They knew this was a company that didn't want to sell, didn't need to sell, but they made an offer that was hard for the owners to refuse. That was in 2012. Last year, First American Equipment Finance, or this year rather, First American Equipment Finance will earn 3 times what they did in 2012. So it's been a win-win situation for the buyer and the seller. Equilease is a small ticket lessor concentrating in truck financing. They were acquired by a private equity group. Coactive Capital Partners, a small ticket vendor leasing company, acquired by Element Financial, the Canadian company that has been growing so quickly. Celtic Leasing, primarily in the IT and medical equipment market, fair market value leases. They were acquired by MB Financial Bank, which is also very active in the leasing of IT equipment. In 2013, Irvin Leasing, a small ticket vendor leasing company, was acquired by a bank in their hometown. And Financial Pacific Leasing, which I mentioned previously as being a very attractive deal for the private equity owner, they sold to a $20 billion bank based in Oregon that had been one of the funding sources for Financial Pacific Leasing, and the Alta Group represented the bank in doing due diligence on that acquisition. The number of acquisitions increased greatly in 2014, and the market's been very strong since then. PHH Arville, a major transportation equipment leasing company, was acquired by Element. Direct Capital, a small ticket leasing company, was acquired by CIT. One of Alta Group's clients, National Machine Tool Financial, was acquired by a bank. Tip Capital, active in the IT marketplace, acquired by one of their banks. Baytree Financial Group, a client of the Alta Group, which was owned by a troubled bank. The bank was not going to be liquidated, but they had some financial problems and decided that their most valuable asset was their vendor leasing business, and we sold that business to another bank. Microfinancial was one of the few publicly owned leasing companies in the U.S. Their average lease size is about $10,000, and they were acquired by a major private equity firm in December 2014. As you can see, in 2015, the number of acquisitions has picked up. You know CSI as being very active in the Latin America market. 35% of that company was acquired by Central Tokyo Leasing. Macquarie, the large Australian bank, sold their US-based IT equipment leasing company to Huntington National Bank. Eng's Commercial Finance, a truck leasing company, was acquired by a private equity group. The Alta Group performed due diligence on Eng's Commercial Finance. Commercial Industrial Finance was acquired by a bank. Advantage Funding, Macquarie didn't totally leave the U.S. market. They bought Advantage Funding, a company that leases specialized vehicles such as buses, limousines, etc. Patriot Capital, a client of the Alta Group, was acquired by a bank in their hometown. Atlanta. And these 3 GE Capital transactions have been announced but not completed, but I'm sure that they will be completed before the end of this year. Now, the pipeline, I think, is pretty full for transactions that will be completed early in 2016, too. The Alta Group has 3 current clients that we expect sales to be announced in early 2016. In concluding my remarks, I'd like to share with you what we have found in selling a wide variety of leasing companies to be the top considerations of acquirers in valuing an acquisition candidate. And if you are a buyer, these may or may not correspond with what your hot points are. If you're a seller, make sure that you've done all you can to be viewed with very attractively by a buyer. Number 1, quality and depth of management. We often find quality of management but lack of depth. In an independent leasing company, the founder and president typically wears many hats. He has good second-line management, but he may not have thought about hiring somebody that could be his logical successor. So if there's not a succession plan in place, if there aren't more than one, or at least one, potential successor to the CEO, that would be a negative factor in the eyes of many acquirers. The attractiveness of the market served. It's certainly better to be a specialist in a unique market than to be a generalist serving all markets. The unique value proposition and competitive differentiation that you may have, value-added services, if you can, if you've offer something that your competition doesn't offer, that can be a strong selling point. It's important to have growth in profits and in originations, and that's why leasing companies are more attractive in good times than they are in bad. The growth potential and scalability is important. We were in the process of selling a company recently that has a very nice market in a narrow geographic area. All their employees are located at the company headquarters, and all of their business is located within 2-hour driving distance from their headquarters. We had one buyer that wanted to expand this business nationwide, but their final conclusion was the business isn't scalable. The owner is not comfortable, who's the owner is the president, he's not comfortable in running a business that has people not located at the headquarters that he can't see. Whether that judgment was right or wrong remains to be seen, but for that buyer, that was an important point. And return on investment. Sellers always or usually think their business is more than it is to a buyer. But to a buyer, the seller should remember this has to represent a decent return on investment. If your business is earning $1 million a year and you want to sell it for $20 million, well, what kind of return is the buyer going to get compared with alternative investments? So that also is a very important consideration. And that concludes my remarks, and I'll turn it over to Guillermo.